President of the Society, the office bearers, the past presidents, my seniors here, and all my dear friends. You just mentioned about 6 consecutive years, the president. In the current budget, there has been a new regime introduced, and that's our default regime. I think this is the 6th year of the default regime while I am here. It was on account of a change necessitated by legendary Sri Dastur not being able to make it, not desirous of being able to make it, that we have by default a new regime created. You correctly mentioned the President that on an overall basis, in terms of the direct tax provisions, the current budget is overall very satisfactory. There are bound to be at least half a dozen provisions any year, any person, any finance minister that you may or may not agree with, but overall, it sounds better, it sounds good. But if one has to certify what a budget is, in terms of direct tax, the 2 facets that it must address should be ease of compliance and whether it will promote litigation or it will reduce litigation. I can say on half a dozen points, some of which we'll discuss today, that there is bound to be promotion of litigation on account of the provisions. I think with all the pending appeals, we should not now enter into an era 10 years hence that we not only have commissioner appeals, joint commissioner appeals, but we have assessing officer appeals as well, because we are not able to cope up with litigation. In terms of expectation, people thought there could be something the budget will say on Pillar 2 introduction, some changes with regard to the buyback tax, but we find that none of the hopes have come true, and I think no change is in itself a welcome step on many occasions. But on the very first blush, when we find that the maximum marginal rate has been brought down from 42.7% to close to 39% in a new regime for people having income above rupees 5 crores, it requires courage on the part of the minister to withstand the pressure and say that no matter what people say, we do not believe in the theory that there must be increased taxation, that there must be killness of the rich people, that there must be distribution of the wealth so as to create, as Mr. Palkhiwala always used to say, that if you distribute entire wealth of those who are wealthy, I think while they will lose wealth completely, each one in India will probably get 100 rupees or so. So that's not what we are looking for. When we heard the budget, the speech contained provisions, a reference to decriminalization of 3,900 various different provisions. I was quite bullish that there would be quite many candidates appearing in the finance bill in terms of decriminalization. But the only provision that we find is section 276 capital A, where we are told that a liquidator of a company in respect of his defaults cannot be prosecuted, though the penalty provisions will continue. There are a lot many provisions where one would believe that there must be decriminalization. We'll have to wait maybe for some more budgets in order to find out what provisions are decriminalized. Let's consider Section 276A to be the beginning of the era to come. With this, may we proceed with some of the proposals. We can even accept them as if they are the accomplished amendments so as to avoid circumlocution. Clinically, they are just the proposals. They are not yet part of law. There are more than 100 changes, and therefore, by force, we will have to limit ourselves to something reasonable with the outer time limit very rightly defined by the President. The first proposal we take up is the rate of tax and alternative tax regime. We always had two different regimes, new regime and old regime. Earlier it was the old regime which was a default regime, whereas now onwards we will find that new regime will be our default regime. A new regime is one where the incentives and deductions will be far limited. Not that there are none, but they are far limited. But we can still call it incentive-free regime. On the other hand, we have old regime where we find that there are a host of incentives which one can claim after furnishing very evident evidences which are required in order to support the incentives. Now, what is the essential difference between new regime and old regime in terms of the impact that we are going to face? Under the new regime, that is the incentive-free regime, or default regime, if you are a salaried employee and if income is up to 7,50,000, then there will not be any tax at all. If you are not a salaried person, carrying on maybe business, and if income is up to 7 lakhs of rupees, there will be no tax at all. So blindly one can say that if this is the income level, opt for new regime, you don't have to pay any tax, it's favorable. If your income is above 5 crore of rupees, then on account of the surcharge rate, which has been reduced in case of a new regime, as a result of which the marginal rate has come down from 42.7 to 39%, you will find in almost all cases that above 5 crore, new regime is the beneficial regime. It is in relation to something which is between the two that some calculations will be necessary. But a ballpark number, for example, would be that if your income is above 15 lakhs of rupees, 15 lakhs of rupees, and up to 5 crore of rupees, the old regime can be of some advantage to you only if the total admissible deductions are at least 3.75 lakhs. Admissible deduction and not admissible investment. Say, for example, in terms of spending, it is when I give a donation of 1 lakh of rupees that I get a deduction of 50,000 under 80G. I must be able to get 3.75 as a number in terms of actual deduction which is due to me. So you spend a lot many amounts in order to earn that deduction. One would therefore be vigilant that better test out the cost-benefit analysis. We must remember on an old regime that while it may be beneficial, it requires a lot of compliance, gathering of evidence, verification of evidence, and If you fail on claiming the incentive for any reason, then in that case you may regret that you should not have opted for this particular regime. The second amendment which we now deal with, a very impactful amendment, Section 56, subsection 2, clause 7b. A closely held company receiving shares, allotting shares to a non-resident, receiving money in lieu of allotment of shares from a non-resident. It is a provision where we are told that if any person subscribes to or is issued shares of a closely held company, equity shares or preference shares, and if the amount contributed is more than the fair market value of the instrument, then the differential will be considered to be income of the closely held company. If you are a widely held company, you don't have to worry. The logic of taxing the closely held company would be that you got a bounty, you got sort of a gift from somebody. In return, you are giving something lesser compared to what you are receiving, and any bounty or any gift that you receive should be considered as your income. The provision was always existing. Residents were covered. I'm sorry, right in the beginning I didn't expect this. Sorry. Any shares allotted to a resident, the provision was always applicable. There were no doubt certain exemptions. For example, a registered startup was exempted. AIF contributing to the shares, the transaction stands exempted. But in relation to the residents, the provision was always applicable. Now the provision will be agnostic to a resident as also a non-resident, because the non-resident is also now getting captured. Now why is it that inviting a non-resident into this provision could be a little more tricky as compared to the case of a resident? You need to contribute something which matches with the fair market value in order to comply with the FEMA provisions. So there is a benchmark, you can't take a chance, you need to comply with a provision. FEMA, of course, doesn't compel to necessarily bring something more than the fair value, but people, just out of caution of satisfying the FEMA authorities, used to err on the safe side that we go by a contribution which is not under challenge with FEMA. Let's leave aside the FEMA factor. The provision will now be tested out that if there is a merchant banker report available and the merchant banker report says a certain value and one has reasonable expectation that the merchant banker report is not likely to be challenged, then in that case, amount contributed equating the merchant banker valuation can be regarded as a good valuation. But the valuer normally does not always define a precise value. He may define a range of value, say from 200 to 215. I would personally believe that when a range is defined and we are dealing with a case where an estimate is involved, one should fairly go by the higher of the range before applying the provision. Of course, a far easier thing will be that a band could be provided, just as in case of, say, Section 50C or 43CA, to say that if the estimate were to vary to the extent of 15%, then in that case, the provision should not apply. Some very interesting questions which will arise here would be that take, for example, a parent foreign company which is a wholly owned subsidiary in India. In terms of the economic interest, whichever is the value at which additional shares are distributed or contributed, you will find that there is no impact, there is complete neutrality on the economic value. But for the purpose of Section 56 to 7B, it is the allotment which is made today which is important. We need to focus on the additional shares. And if there is a challenge on the fair valuation versus the amount contributed, then you find that the addition will still be made in the hands of the subsidiary. This will also now be a transaction covered by the transfer pricing provisions. Documentation may need to be maintained. And once there is a transfer pricing operative, and if the arm's length price determined as per some of the methods applied by the TPO is at variance with the prices which have been considered by the parties, then it is possible that the parent company may get a cost in the hands of the parent company at the time of eventual transfer, which is equivalent to the arm's length price of the transaction. These are some possibilities that we may need to be prepared about. The third amendment that we take is capital gains exemption with regard to residential properties. We have Section 54, where what we find is that if a person earns capital gain from sale of a residential house and the amount of capital gain is invested back in another residential house, then the capital gain will not be chargeable to tax. Up to assessment year 23-24, this provision will continue without any change. Either invest in a residential house or invest into the capital gain account deposit scheme. The aggregate thereof, if it matches the capital gain would be exempted. But there is no value limit which was bothering the taxpayer. Section 54F, I may sell any asset other than a house, and if I invest net consideration into a new house, then in that case, the capital gain would be exempted. Again, no value limit. So there were reported cases of some of the promoters of the startup companies having earned huge capital gain and having bought property worth 100 crore, 200 crore, a single residential house. Now that immediately caught attention. So what has now been said, effective from assessment year 24-25 is that by and large, the methodology will otherwise continue, but the value limit up to which you can make an investment is reduced to 10 crore. Very correctly speaking, your investment could be higher than 10 crore of rupees, but the law will deem as if you have invested nothing more than 10 crore of rupees. So take for example, effective in 24-25, I sold a house cost was 5 crore, I sold it for 15 crore of rupees. I get capital gain of 10 crore. I invest an amount of say 11 crore of rupees, but the cost will be taken to be 10 crore. It doesn't affect me because to the extent of capital gain, in any case, there is a recognized or a valid investment even under the new law. My entire capital gain is exempted. House costing 5 crore, supposing I sell for 20 crores of rupees. Capital gain now is 15 crores of rupees. I make an investment of 15 crore of rupees. Old law, I would have qualified for complete exemption. But now in respect of the new house, the cost will be deemed artificially to be 10 crores of rupees. I have invested 15 crore, but valid cost, recognized cost is only 10 crores of rupees because of the change. So the equation is that I am earning capital gain of 15 crore. I have invested 10 crores of rupees, the pegging down value. There is a differential. I therefore pay tax on capital gain of 5 crore of rupees. Now this works out well. But there is one scenario in which I think that there will be a snag and that requires to be corrected. Let's take an example, property of 5 crore, sold for 20 crore, capital gain 15 crore, the same figure that we assumed. I buy a property worth 12 crore of rupees, peg down limit is 10 crore, so I pay tax on the differential amount, capital gain 15 crore, invested 10 crore, on 15 crore of exemption, investment is 10 crore, and therefore I pay tax on 5 crore. I am now buying a new property for 12 crore of rupees. Suppose I am required to sell that property within 3 years. I am told in this section, which has not been amended, is that if a new house is sold within a period of 3 years, then for working out capital gain from that new house, my cost will be deemed to be nil. It will be deemed to be nil in a case where capital gain has exceeded the cost of investment. Now, if this property bought for 12 crore is sold for 12 crore, and if the cost is deemed to be nil, then I will pay tax over again on the sale of new house 12 crore of rupees. I first paid on 5 crore, I now pay on 12 crore. My commercial capital gain income has been only 15 crore, but I will be required to pay tax on 17 crore. This needs to be corrected, and in fact this is the only situation where we found that the arithmetic may fail. Only one small sideline. If there are two brothers in a family, they were owning a property and they now buy a new house, which again is in a joint ownership, then the provision should be applied per person and not per a residential unit. Also, very, very arguable that Section 54 and 54F benefit, if I am qualifying, then the two of them may continue to operate independently. It may not be that in some appropriate situation, subject to my fulfilling all other conditions, so one will not necessarily exclude the other. The next, a big ticket change, which will again have a very high impact. Capital gains chapter. We are told right from our young days, namely, that if you want to attract the capital gain chapter, 3 conditions are necessary to be fulfilled. The first one, there must be a capital asset within the meaning of section 2 subsection 14. Second, there must be a transfer of a capital asset against consideration which accrues on transfer. And the third, that the capital asset which you are transferring should be one which had a cost of acquisition. Out of the three limbs which are to be remembered on capital gains chapter, the first two limbs are not touched by the current finance bill at all. The requirement that there should be a capital asset within the meaning of 214 will continue as it is. This will have some impact for considering some of the illustrations. Second, there must be a transfer. It continues as it is, no change made. But it is the third limb which is now going to change. The third limb is nil cost asset. In the celebrated decision of Supreme Court, we found that goodwill of business was considered not to be a capital asset which can be subjected to capital gains chapter. The Supreme Court laid down the proposition that if we are dealing with an asset in the acquisition of which cost is not conceivable, then in that case, the transaction cannot be subjected to capital gains chapter. Srinivasa Shetty's case. Over the years, the courts consistently interpreted this to say that if you happen to acquire any asset for nil cost, then the capital gains chapter will not apply. So that's why we always say, is it a nil cost asset or not? Cost being conceivable, not conceivable is not relevant. It's a nil cost asset. So whenever you deal with a transaction and you find that the cost of acquisition is nil, you could comfortably say that the capital gains chapter will not apply. Over the years since 81, exception was drawn by inserting section 55. The legislative thinking is that for an otherwise nil cost asset, cost can be attributed by the legislature to be nil in section 55, then the transaction will be now within the canvas of capital gains chapter. A lot many assets by now have been included in section 55. This year, two more categories of assets are to be included, and the provision will be effective from assessment year 24-25. The first one, every intangible asset will now, for the purpose of capital gains chapter, be a nil cost asset in section 55. So if there is transfer of an intangible asset, your answer to the client will be that capital gains chapter will be attracted. You can't rely on a nil cost theory. The illustrations could be, one can't argue that a design or a formula or a patent which is transferred should be regarded as a nil cost asset to be exempted from capital gains. Second, we are told that into inverted comma, other asset, that is every other asset which might have been left out of section 55 will be considered now to be part of section 55. Exact wordings are other right. So if there is to be giving up, extinguishment of any other right, which we can colloquially say any other asset, and if there is a nil cost, then now onwards, despite nil cost, the asset will be part of capital gains chapter. So supposing a person is in adverse possession of a property for a period of more than 12 years, he may have taken adverse possession without incurring any cost. That's a right which he has under the Limitation Act that will now be part of Section 55. An industrial license could be considered to be part of other right which a person has. In case of a cooperative society, the bidding right, and there is to be reconstruction of a cooperative society, you may find that the no-cost argument may not now be serviceable. But there will still remain certain items where debate will arise. Accident compensation, for example, or alimony receipt, for example, will they or will they not be still covered is a matter of debate, only time will say. Now that takes us to the next amendment to which the President referred to, namely expanding horizon of Section 43B, MSME, to which the President made a reference. This is going to make a huge impact in certain cases, more so because innocent cases are likely to be trapped either on account of interpretational difficulty or otherwise, whereas people who are aware, they will plan their affairs in a manner that they don't get into the net of this provision. What is Section 43B? We are aware that as part of social welfare legislation, government uses Section 43B to say that if you don't make certain payments in time, then the deduction which you get for computing total income will match with the actual payment and not on the basis of accrual. It started with custom duty way back, but now we have a number of provisions where we find that if you don't make payment in time, don't claim expenditure on the basis of mercantile method, you may have to wait for the actual year of payment, and some different rule may apply for some items if payment is belated but made before submission of the return of income becoming due. Now, what is the next item covered with regard to MSME in 43B? It's not interest paid to MSME which has been corrected. In fact, Section 21 of MSME Act makes a provision that if you have to make any payment to a micro unit as defined in MSME, or if you have to make any payment to a small unit, again as defined, and if you don't make payment in time, and the provisions are so worded that the maximum credit period which you can enjoy will be 45 days, you can't enjoy beyond that. Even if the two parties are willing to sign an agreement and say that you are willing to extend a credit of 60 days, MSME Act says that agreement will not have any effect, you must pay in 45 days. If you don't pay in time, Section 21 says exorbitant interest payable to a micro or small unit. By virtue of overriding impact in MSME Act, interest paid is not deductible at all in computing income under the IT Act. What is now sought to be covered is any sum payable to a micro unit or a small unit. The fun of the situation is, it's not a large unit making a default in payment to a micro or a small unit. a micro unit making a default in payment to small unit is also going to be covered. So you are making a provision to ensure liquidity of a certain class. While you correct the problem for somebody, you are creating a problem for some other person belonging in a tiny measure to the same class. So that's a pinch of salt which requires to be corrected. It should be limited, if at all, only to a medium or a large unit. Now, why this provision becomes tyrannical is that any sum payable will largely include the goods which I am purchasing from a micro or a small unit. If I am dependent on all my supplies on a micro or a small unit, and supposing the raw material cost for me is constituting 80 to 90% of the turnover, then on account of a delay even by one day, I find that I pay tax on at the full rate on the entire disallowance of 80 to 90% of my total cost. Some of the units will virtually go bankrupt if they miss out on compliance with this particular provision, and one of the units could be a micro unit which goes bankrupt because it could not make a payment to a small unit. The second issue, which is again far more paramount, will this provision apply only in a case where the macro or small unit is otherwise registered as such under MSME Act? Out of 8 crore units, only about 10% are registered, others are not registered. Section 43B makes a reference that if I default in making a payment beyond the time limit in Section 15 of MSME Act, then I suffer certain consequences, as we described. Shilpi Industries case, under the MSME Act, Supreme Court takes a view that the benefit of Section 15 is available to MSME unit, provided it has got itself registered under MSME Act. Keeping that in mind, a better view of the matter appears to be that only in a case where default pertains to somebody who is otherwise registered under MSME Act, that I need to be very careful. Now, if provision, because of the ambiguity, is made applicable to everyone neutrally, then there is a sure shot difficulty in finding out whether you are dealing with a micro or a small unit, or it's really not so. So that would be a case of compliance which will be very, very onerous, and some corrective steps are required to be taken. I think a better scenario will be to ensure that the provision is not enacted at all. It would be too harsh for anybody who is trapped by the provision. In any case, limit it only to registered MSME. One more support is Vivad Se Vishwas arbitration claim scheme, which has been introduced for government companies who have forfeited the amounts due from the MSME, etc., received from MSME. Those schemes are restricted in application only to registered MSME unit, which is an additional support why, if at all, it must be restricted only to the registered units. The next which we have, and which will impact every one of us in small or big measure, could be life insurance policies, coverage as income from other sources. We have section 10, subsection 10D today. And what it says is that if I am holding any LIC policy, I am making annual premium payment, and if the annual premium payment is less than 10% of the life assured throughout the life of the policy, then whatever amount that I receive on maturity, either in one lot or in installments, the entire amount together with accumulated bonus will be considered to be my exempt income. There was no value limit placed. I can have a policy where I pay a premium of 1 crore of rupees every year. I ensure that it is less than 10% of value assured for 12 years. And when I receive the money, it would be considered to be exempt. Sorry again. The change that we are now going to face is that other conditions being equal, the premium amount, if it exceeds 5 lakhs of rupees a year, one will not qualify for the exemption. So if I have a policy, annual premium of 7 lakhs of rupees, I wait for a period of 12 years, pay 7 lakhs every year, much below 10%, but I find that when I receive the money, it will not be considered to be non-taxable wholly. Amount received minusing out the premium cost which I have incurred till date will be considered to be taxable. If I have got two policies of 2.5 lakhs each of the annual payment, then both the policies will qualify because the aggregate amount does not exceed 5 lakhs of rupees. Supposing there are 3 policies of 2.5 lakhs each, then I need to choose a combination of which 2 policies that I would like to opt for, such that 2 of them will be covered by 1010D and 1 of them will not be covered by section 1010D. The provision applies qua person. So there can be 4 earning members in the family. Each one can have his own insurance policy. That does not make a difference. If there is a head of the family who is, with regard to life assured not being he, takes a policy, he needs to be careful about it because it's virtually a gift that he is making. Somebody else happens to be the life assured. Now let's presume that amount is going to be received by me in installment. So how will the taxation take place? Fine to say gross receipt minus the premium cost. Premium cost might have been, say, 50 lakhs of rupees. Over a period, I will be receiving, say, 70 lakhs of rupees. So on a totality, I am aware that I will need to pay tax on 20 lakhs of rupees. But when I receive the first installment, how do I know, because it is less than 50 lakhs, do I or do I not pay tax? Power has been taken to prescribe the rules in this behalf, and the expectation is that they made a provision or a correction with regard to the ULIP schemes 2 years back. In a similar fashion, possibly the payback method will be adopted, that to the extent of the first amount of 50 lakhs that I receive, I don't pay any tax, but on the incremental 20 lakhs, as and when I receive in future, the amount should be considered as taxable. Now the next amendment, proposal. market-linked debentures, whether listed or unlisted, provision taking effect from assessment year 24-25, but will have retroactive impact. If I am covered by this provision, then with regard to market-linked debentures, whether listed or unlisted, which I might have taken or subscribed even earlier, will be covered in the year of maturity or transfer of the provision, of the debenture. Now, what are market-linked debentures? Read with the definition. There is a debt security. And when can it be a debt security? When the principal amount which is repayable is guaranteed, is assured. It's not a growth security in a manner that I contribute 100 rupees, I may not receive 100, I may receive less. That's not what we are talking. I will in the minimum receive 100. That would be a debt security under the SEBI regulations. While the debt is secured in terms of the principal amount, the returns are variable returns. The returns will vary depending upon the derivative component linked either to some index or to some other bonds or security. Now, in such a case, tax authority could have, in appropriate cases, possibly argued that whatever return which is received by a person is in fact in the nature of interest income and is therefore subjected to the full tax. Now, instead of doing that, they are referring that in some instances, people have claimed the amount as long-term capital gain. They pay tax only at the rate of 10% on a security, and therefore, we now want to make a correction. By way of a correction, it is now stated that in all such cases, on redemption, transfer, or maturity, the gain, the surplus which is received, will be considered to be short-term capital gain within the meaning of Section 50AA, and the section is worded in the same manner in which Section 50 dealing with depreciable asset has been worded. So firstly now, there is a concession that the legislative thinking is that this is to be treated under the capital gains chapter and not under any other chapter. What can be a fallout of this? The fallout of this could be that some non-resident who as per his treaty finds that the capital gains article is a favorable article for him will now claim that doesn't make a difference whether it is long-term or it is short-term. I will consider this to be capital gains income and I don't pay tax on this. If one is right that by default it would have been long-term capital gain, then no impact. Even otherwise he was treaty exempt. But if there was a scope for taxing him on interest income, you may find that there could be a loss of revenue, in fact, as a result of the change. The way the section is worded, at par with depreciable asset section 50, there would arise a host of other interpretational issues as well, with which we may not today be concerned. Now, linked to this particular provision is one amendment which has gone somewhat unnoticed. Section 193 says that there is no requirement of deducting tax at source with regard to an amount which is paid on a security. Now that applied not only with regard to the market-linked debentures, but to other securities as well. That section has been omitted. As a result of that, we will need to check up that in relation to which of the other securities which the company has allotted or issued, there is likelihood of an exposure to TDS obligation. The next change, which should have been in fact on a more positive side, but a change which I would consider to be a negative change. The charitable trust. And somehow the charitable trusts have become a favorite subject. Agreed that there would be certain charitable trusts which might have played some mischief. But there is a wholesale punishment which is being meted out to the charitable trust year after year. One would have expected that after the two Supreme Court judgments, charitable trusts are not aware as to where they stand, whether they have to pay tax, not to pay tax. So some sympathetic view will be taken and a positive affirmative amendment may be made. But far from that, the amendment is a little not so fair amendment. It can be on the borderline of being an unfair amendment. Now, what is amendment number 1? The amendment is that supposing you have been till today a registered trust. Now you find that you are unable to cope up with so many formalities and therefore you are prepared to pay tax. You feel that let me not register, I am happy as an unregistered trust. I will pay tax on whatever income which is computed. Second could be that if I am a registered trust, periodically every 3 years, 5 years, time limits keep on recurring, and whenever my registration is expiring, I should apply and seek registration. There are strict conditions for applying and seeking registration, and supposing I forget to apply or there has been a delayed application and my registration is therefore refused or I am not registered. Now what can happen in these situations? And the proposal is that in these situations there would be exposure to exit taxation. Now let's try to find out what is exit taxation, and then we come back to how can it impact our trust, why do I consider it to be unfair as a provision. Exit tax is like estate duty, namely that when there is an exit of a trust and the tax authority wants to read it, exit from the chapter on charitable trust, then on the entire market value of the property of that trust, tax at normal rate will be payable by a trust. So there is an educational institution which is 50-year-old. It bought an immobile property for 100 rupees, which might be today 100 crores of rupees. The school is incurring losses or hardly any profit, and you find that in this case they forgot to apply for registration, though they were registered earlier. So the provision is that find out the market value of the properties of this trust and recover tax because it is a candidate for exit taxation. If the trust cannot pay the amount, tax can anyway be recovered from the trustees, and we have instances of all the people sitting here, some of them happen to be the trustees of the charitable trust. Exit provision is good and nobody complain in a case where somebody holding property as a charity now converts that property into a personal property or a non-charity. Or if you find that the activities are no more genuine, so you cease to be a charitable trust. You are exiting from your objective to which you are wedded, and therefore there could be exit taxation. But here what is happening is, the poor accountant forgot to file the registration application. Trust is now unregistered. It still continues to be charity. It continues to hold property as a charity, spend money as a charity, but since you did not apply for registration or you chose not to apply for registration, you pay exit tax and then proceed. Very funnily, there is no concrete provision for a cost step-up. So having paid tax, it doesn't mean that there is a cost step-up in terms of the property that a trust is holding. So when a school were to sell the property, you will find that once again, there may be a demand for capital gains tax. The logic which has been given is that you earn money as a charity, you acquired property out of money for which exemption was granted, and therefore, now if you become unregistered, you ought to be taxed by way of exit taxation. It's telling somebody that you are in SEZ today, you are earning income in SEZ today, you built a new factory by your income which you have earned in SEZ today. Therefore, if you happen to be non-SEZ tomorrow, on the market value of that factory, you are required to pay tax. I think that would not be a correct scenario to my mind. The next amendment, which again I consider to be a relatively very unfair, is dealing with the refund cases and provisions which are not noticed, but which are likely to create inequity or injustice. We have currently a provision in law that if refund becomes taxable, refund becomes due to me as a result of order giving effect to the order of some authority, then somebody should work out my refund and grant it to me within 90 days, 3 months. If that refund is not received by me, I am entitled to 3% additional interest under law. What is now sought to be provided? Supposing I am entitled to a refund of 5 crore of rupees for a year, some past year. Instead of giving that refund to me, you adjust that refund, officer is empowered to withhold that amount and as if adjust it. He doesn't physically adjust it, and which is a complaint. But he has a power and he says that I want to keep that amount with me because there is some other assessment in progress where demand is likely to arise. My question will be, is the amount paid to me? No, it's not paid to me. Is the amount paid to somebody on whose behalf you are retaining? No, it's not paid to him. So the equation seems simple, that the amount has not been paid. Now, in this scenario, would you believe that I am entitled to that 3% additional interest? It is possible that you are withholding 5 crore. Keep that power. It's not that I'm complaining on a power. 5 crore of rupees. I assume you will honestly exercise it. 5 crore you retain on the apprehension that some demand will turn out. but apprehension may not be true at all. No demand may be raised. Then you pay 5 crores to me, you will still not pay 3% additional interest to me. I think a better case scenario would be that in these cases, the moment you are withholding the amount, it should be deemed to have been paid in the assessment which is currently in progress. Once you consider it to have been paid in that year, at least you will see to it that my chargeability to interest in that year gets reduced because of the credit which you give for a refund which has now been adjusted. Now exactly the same result is likely to follow, paramaterial, that a power is also taken that if in one assessment year I have a refund due, but a subsequent assessment is still in progress, where you are adjusting that amount. In such a case, you will pay to me, you don't pay money to me, you will pay to me 6% interest, but you will charge to me 12% interest in the other year. The better proposition is you adjust against the assessment of that year, grant me credit so that I save 12% and you don't pay me interest on refund of 6%. The next one. An important amendment. More so because it is likely to have implications of prosecution in cases that we may at times not notice. We have section 28, subsection 4, where we are told that if there is any benefit or a perquisite which is given in the course of business, then in that case, it is to be considered as business income of a taxpayer. There is a backup provision, section 194, capital R. We are told that if there is anyone who gives to you a benefit or a perquisite which is chargeable under section 28, Roman 4, then payer has to deduct tax at source, or payer has to ensure that tax is paid on the value of benefit or perquisite. This amendment came in and the target audience was pharma companies giving samples to the doctors. We are not on the theory part, whether in case of a doctor there is at all a benefit or a perquisite, because in law he can't sell that, he has to dispense it free of cost. But let's assume that we continue to believe that there is a benefit or a perquisite. And there could be instances where amount is recovered by the doctors. Second was the dealers or the distributors. They were taken on an overseas tour and the benefit was provided, or there was distribution in kind. Questions arose, when will 28(4) and 194(r) apply? And the court took a view that if there is a cash payment, then 28(4) will not apply. Though in most cases of cash payment, 28(1) would have in any case applied. But anyway, 28(4) did not apply. Since 28(4) did not apply, 194(r) did not apply. Now they want to tighten the screw, and therefore first amendment made in section 28(4), which may have many other implications with which we are not concerned, but an amendment is made that even if the benefit or perquisite is in cash, it will be covered by section 28(4). as a result of which it will now be covered by section 194R as well. Now together with that, section 276 capital B has been introduced. And what we are told is that with regard to any benefit covered by 28(4) and also with regard to certain other items where there is in-kind sparing of the benefit, we are told that prosecution provision will apply in a case where benefit is given in kind, either wholly in kind, or benefit is given partly in cash and partly in kind. 276B doesn't make a reference to payment being made in cash, the benefit being given in cash, because there are other prosecution provisions which adequately deal with the payment of cash and when prosecution could be initiated. But if I am granting to you a benefit in kind, partly or wholly, then I am told that I must either pay or ensure that tax is paid on this amount by way of TDS 194R before I am releasing the benefit to you. I must either pay or I must ensure that you pay. I pay from my own pocket. Once I pay, I can recover from you. I can collect from you and I can pay. I can ensure in the sense that I request you to pay advance tax, you pay advance tax, give challan to me, and now I am assured or ensured that payment has been made. Ensuring payment being made, the legal dictionary meaning is sort of an assurance or a guarantee that I have that though I have not made the payment, you have made the payment. If I fail on this, then there would be an offense of prosecution. Trigger of prosecution on account of an offense. So most companies, supposing pharma companies, they will now have to take a view as to whether they will litigate the matter on first-hand basis, how will they interpret the provision, or most of the companies will see to it that by some mechanism they pay taxes from their own pocket. The next amendment, again not been noticed very much, has been right granted to file cross objections to the assessing officer. Appeals can be carried to the appellate tribunal. Section 253, subsection 1, gives a right to the taxpayer to appeal against the order which are specified, and a long list is given. So right of appeal granted by law, statute to a taxpayer. And so far as a right of appeal is concerned, it has to be granted by law. It cannot be presumed. It's a statute-driven right. Now, in cases where taxpayer has a right of appeal, the taxpayer also has a right of cross-objection. By and large, the judicial and legislative thinking is that on a matter where I have a right to appeal, I have a right to cross-objection. In some case, I may not have filed an appeal, but against the very same order, officer has filed an appeal, then I can file my cross-objection. Section 253, subsection 2, gives right to the assessing officer to file appeal in certain cases. In cases where he has a right to appeal, no doubt he will have a right of cross-objection as well. But now what is sought to be provided is that an officer may not have a right to appeal against certain order, but nevertheless, he can file a cross objection. So if I am an officer, I don't have a right of appeal. But you have a right of appeal, that's what statute says. Now since you have a right of appeal, I should also be given a right of cross objection, is the thinking. My right to file cross objection should not be dependent on my right to appeal, is the logic on which the provision is sought to be made. Now what could happen if this becomes the law? I am the assessing officer. In the course of assessment, disputes had arisen, and therefore as a taxpayer, you asked for directions of commissioner under say section 144A. Directions are given, and the law says that directions are binding on assessing officer. He has to follow the wisdom of the superior, and he passes the order. Second, matter has gone to DRP. Instructions are received from DRP, directions are binding, and in this case, officer has no right of appeal, I have a right of appeal. GAR panel gives a particular verdict, directions are binding, but the officer can have right of cross objection whether or not I file an appeal. Revision order under section 263. Order is revised by the commissioner. Now here, as per the language employed, even against that order, the officer can pass an appeal. If I have filed an appeal against 263 order. So in revision 263, commissioner says that order of the AO is erroneous, and therefore he directs him, and now the officer will come back and say that I don't think it was erroneous, and he comes in cross objection and says that you restore my own order. I think this is likely to be the scenario on account of the amendment which is proposed. It would be better if there is a far more transparent or a far more specific amendment, if one would still like to persist with this particular amendment. One of the last one or two items could be we can take up maybe one item on charitable trust more. Again, something which I don't think is very fair. There is already a provision with regard to a charitable trust today, namely that if out of corpus of the trust 2021 onwards, this amendment is operative, if I have spent any amount from corpus of the trust, it is not considered as an application. But when out of subsequent years' income, I am replenishing or restoring the corpus, it will be considered to be an income, application of the income which I earn in future. Second is that if I took a loan as a trust to spend money, and at that stage, money spent is not application, but if out of my income of a future year, I repay the loan which I have taken, it will be considered to be an application. So at some stage over the life of the cycle, I will get credit for application of an amount of income. It is now sought to be provided that if I have spent money from corpus or from out of loan, then I must restore back corpus within 5 years, or I must repay loan within 5 years in order that there is an application of income. If I fail to pay within 5 years, then despite the fact that application was not considered earlier, I will not once again get an application in the year of repayment, and I'll be exposed to taxation in that year. In this very budget, ironically, we find a reference in the speech of FM that in order to meet certain extraordinary calamities or utilities, central government is to give 50-year interest-free loan to the state government. Now compare our provision. For our charitable trust, our calamity is important. There is an earthquake. Our charitable raise money from wherever and saw to it, including the loans which are taken from people, and they are now trying to make up for the loan. Why should there be a time limit? I can still understand if you say that. I may not get credit for application, provided I am not in a position to submit the evidence, etc. So I think this again is an amendment which requires to be rolled back to my mind. And with this, can we take up only one, the last one, business trust related, very briefly. A REIT or an InvIT is known as a business trust. Section 115, capital U, capital A, is a section which applies to a REIT or an InvIT. It is worded differently from certain other provisions in the same range, say section 115U or UB. If provisions of UA were worded along the lines of U or UB, some of the things which are being corrected today, occasion may not have arisen. But let's live with what the provision that we have. If a business trust is earning interest income or dividend income or capital gain income and is distributing that amount, no difficulty arises. There is a mechanism in place on how to capture this amount, and it works very fairly. Now, what could happen is that there is some income which a trust has. Instead of being distributed by way of income, the trust redeems the units are cancelled, sort of capital reduction, and then you don't make a distribution of income, but there is a redemption of the units. How to treat this amount in the hands of the unit holder? There was almost wholesome view, most people holding a view that just as in case of a company, redemption of a unit resulting in cancellation of unit is a transfer, and therefore unit holder should be subjected to capital gains taxation. Explanatory memorandum proceeds on the basis as if that the amount was not chargeable. With regard to redemption, I think that assumption may not be correct. But anyway, the provision which has now been made is, thinking that amount on redemption was not chargeable at all, it is now provided that any amount which is received on redemption will be considered as normal income to the extent it exceeds the cost of acquisition. But loss will not be allowed if you have incurred loss in the process. Now, this is with regard to redemption, where I think no change was necessary because redemption was always taxable. There are non-residents who have entered on the basis that they would be earning capital gains income. Probably they will still continue to fall back on the treaty and say that, notwithstanding domestic law amendment, we treat this as alienation for the purpose of the treaty. The second one And there could have been a question mark as to why a taxpayer is doing this. There are certain cases where a business trust would borrow money. It's not even income. It would borrow money. Having borrowed money, they pay that amount to the unit holders. But they don't cancel the shares. There is no redemption of the shares. They just make a payment on the basis that any amount which is credited to the capital account is a repayment of the debt. So by borrowing money, amount will be paid. It was considered to be non-taxable. Thereafter, in subsequent years, you find that in subsequent years, income will not be distributed because income will be used for the purpose of repayment of the loans. Now, in order to correct this, and to an extent rightly so, it is provided that if there is any receipt of money by a unit holder, otherwise then in the matter of redemption would be our alternative, but according to the legislature, at par with what happens in case of redemption, amount received, the whole of it will be considered to be in the nature of income. The whole of it because it's money which you are receiving. The fallacy is that money which I am receiving is my own money. And whichever is the section that you deal with, whether life insurance policy or otherwise, to the extent of me receiving back something which is my own, it can't be considered as income. But the provision says gross amount will be considered as income. A fairness in that provision will be that adopt the payback method to the extent I recover what I have given to the trust, don't tax me. Throughout the life, when I receive something over and above what I have contributed, it ought to be considered as my income, whichever way that you would like to tax it. There are some more provisions, but I think the effective ones we have been, by and large, able to capture. May I say that on this budget, we will end with a happy note because overall good provisions so far as the direct tax goes, about half a dozen provisions where I have shared my views. Maybe if BCS is agreeable as part of representations, some of them can be taken up. What has spoiled the party is, I think, the cough and cold which I am carrying. Extremely sorry for the disturbances which I have created. Thank you.